MBA ASAP. MBA ASAP. Hello and welcome to another episode of MBA ASAP, where we explore business skills and knowledge so you can level up your expertise and learn skill sets that will make you more valuable at your job and career, or help you start something on the side, a little side hustle, or let you quit your job and start your own business. I'm your host, John Cousins. Let's get started. Hello, and welcome to the MBA ASAP podcast. Today we're going to talk about corporate finance. We're going to talk about the numbers side of business. And you might think of this like when you were a kid and you had to eat vegetables, like, oh my gosh, this is a boring subject. But you know what? The numbers side of business, at the end of the day, business is about keeping score, and it's about the numbers. So understanding accounting and understanding corporate finance are critical. Especially if you work for a company, there is an accounting and corporate finance department, and these people are steeped in the numbers. And if you want to get ahead in business and at your company and climb that corporate ladder, then you really need to know about the numbers and be well-versed in how to talk about them. After you're done with this is about a half-hour show, you'll have a great idea about these corporate finance techniques. If you have an investment portfolio or are thinking about investing in stocks or interested in the stock market, then corporate finance is the way that you understand how to value stocks and look at which stocks are comparatively a better deal. The first part that we're going to look at here is ratio analysis, and that's where you take and apply analytics to the financial statements, and that's how you can compare publicly traded companies off of their financial statements. So that's critical if you want to make wiser investing decisions. And an interesting thing, a couple of years ago in economics, there's a famous economist, a Frenchman, Thomas Piketty, and he wrote a book that basically the premise of, it's called Capital. And the premise is that the middle class is eroding and that it was just an aberration basically after World War II. And what's going to happen is most of the money flows to capital, not to labor. So we can sit there and bemoan that fact as employees or whatever, or we can start to become capitalists and owners of companies. And you can do that through the stock market. It's easier than ever now because you can have very small trading fees and accounts like E-Trade and Ameritrade and Charles Schwab. And you can start to invest in the stock market. But you really need to know how to invest and how to make intelligent investment decisions. And these are the techniques that Warren Buffett and all the other wise financiers use. So it's good for your career, it's good for your investments, so for your future and for your retirement. It's also good if you have any aspirations as an entrepreneur, because this is how you value entrepreneurial enterprises. You take the forecasts of what you're going to make in the future, pull them back into today's dollars, and that's the valuation of which you give a piece of to investors. So that way you can figure out how much your company is worth. So this information is really critically important for you. So I hope you take the time. I hope you listen to this. If you have any comments or questions, if there's anything that's not clear here, please email me at john.cousins@mba-asap.com. These segments are from my new book, MBA ASAP, 10 Minutes to Understanding Corporate Finance. And I hope you'll check that out and get a more detailed view of it. Again, it's a very short book and covers these topics very clearly, I think. What we're going to start with is financial statements and the financial ratio analysis in these segments here. Then we move into the time value of money, which is a core concept of finance, and then discounting cash flows, present value and future value, and then we're going to look at the big analytic tools, net present value and internal rate of return. So if you've heard these words before and don't really totally understand them, stay tuned, because after this half hour, you'll have a really good conceptual basis of these analytical tools, and you'll be able to start using them with Excel and other techniques. So I hope you enjoy this. I hope to hear from you. And now let's start with an introduction from the book, and then we'll step through those different those different segments, and I'll come back and talk to you in between them to give a little bit of color on what's coming up. Introduction. Finance is a broad topic that can be challenging to initially wrap your mind around. For clarity's sake, it can be thought of as organized along economic lines of micro and macro. On the micro side, we have business decisions and corporate finance. On the macro side, we have financial markets, money, and banking. This ebook will focus on corporate finance, how companies make decisions about what projects to pursue, and how to value those projects. This book will provide a framework for how financial professionals make decisions about how, when, and where to invest money. Corporate finance comprises a set of skills that interact with all aspects of running a business. It is also extremely helpful in our personal lives when making decisions about buying or leasing, borrowing money, or making big purchases. It provides analytic tools to think about getting, spending, and saving. We will look at the time value of money and develop a set of tools for making good financial decisions, like net present value and internal rate of return. We will explore the trade-off between risk and return and how to value income-producing assets. Valuations of companies and assets can seem mysterious. Where do you even begin? How can you value a startup that doesn't even have any revenues yet? This book will help you gain confidence in your knowledge and understanding of finance. The tools of corporate finance will help you as a manager or business owner to evaluate performance and make smart decisions about the value of opportunities and which to pursue. An understanding of corporate finance is essential for the professional manager in order to meaningfully discuss issues with colleagues and upper management. You need to be versed in this subject in order to climb any corporate ladder. Next, we'll take a look at ratio analysis. Ratio analysis is taking two numbers and placing one over the other to form a fraction or a ratio. It's basically a way to compare one set of numbers to another, and what that allows us to do is take out any type of scale difference between comparing two different companies or a company over time. It's a very powerful tool. It looks at retrospective information, that is, looking back at the past. The ratios come from the financial statements, where you're comparing one number to another. It could be two balance sheet numbers, it could be two income statement numbers, like price-earnings ratio, or it could be a balance sheet number compared to an income statement number. Those are the usual ways that ratios are formed. They first became popular in the 1930s. In 1933 and 1934, after the stock market crash of 1929 and the onset of the Great Depression, it was looked at to start a government agency that would police publicly traded companies. One of the requirements became that these public companies would now have to file audited financial statements. That was never done before. So suddenly the public had access to all of these publicly traded companies' financial statements, and we started to wonder about what could you do with those numbers to make some meaningful and intelligent decisions based on those numbers. And a fella named Benjamin Graham wrote a book in the late 30s called The Intelligent Investor, where he went through and basically using ratio analysis looked at these financial statements and said, here's ways that you can compare apples to apples, these different companies, and start to compare which is a better investment, or look at a company over time and see if its value is eroding or actually increasing. That became extremely popular. One of the iconic disciples of Benjamin Graham is Warren Buffett. And Warren Buffett took that information, and basically that's how he has made his career. His investing career is predicated on value investing, and that's the Benjamin Graham type of way. Benjamin Graham, in subsequent editions of that book, had a co-writer called Dodd, and it's Graham and Dodd's Intelligent Investor now. I suggest you pick up a copy of that book and check it out. It's a fascinating read, and it's the way that all smart investors start out to look at value investing, looking at companies and looking at their value. So now we'll take a look at these ratios from the book chapter here, and it'll give you a good idea about how these ratios are put together and what they really mean. Chapter 1, Ratio Analysis. There are essentially two basic techniques that are used in corporate finance. One is the ratio analysis of financial statements, and the other is calculating the present value of future cash flows. Bankers, investors, financiers, CFOs, and entrepreneurs use these tools and techniques to value assets and make decisions. Let's look at using financial ratios as a budgeting tool. There are lots of different accounting ratios that get used inside a firm. In fact, a lot of times, the same accounting ratio gets called different things at different firms. By ratio analysis, I mean taking two numbers from financial statements and dividing one by the other. What we are doing is taking two pieces of accounting data, put one over the other, and this forms a ratio. We are taking two pieces of data and forming a performance metric. Ratios are usually presented as a percentage or a number, depending on whether the usual case is bigger or less than 1. Besides being a capital budgeting tool, ratios allow us to compare different companies or a company over time. Ratios are great tools to do this comparison because they allow us to normalize the numbers. A ratio eliminates any size difference and allows for pure comparison, so you can compare apples to apples. Financial ratios are derived from accounting information and rely on an understanding of financial statements. If you need a primer on this subject, check out MBA ASAP, 10 Minutes to Understanding Financial Statements. It will get you up to speed on this critical business skill quickly. A particular common valuation of companies done by ratio analysis is based on multiples of earnings. It's called the price-earnings ratio, or PE for short. It's a way companies are compared based on their stock price relative to their earnings. The earnings number is the bottom line of the income statement. Earnings are also referred to as net income or profit. This ratio works well for comparing public companies that report these numbers. This technique can also be used to value a private company by comparing its earnings and valuation range to an average of public reporting companies in a similar industry sector or market. Other common ratios based on the balance sheet are return on equity, or ROE, return on assets, ROA. A company can basically be thought of as a bunch of income-producing assets. These assets are bought using two types of funding: equity, which is money investors put in, and debt, which is borrowed from a bank or other lender. We can use ROE and ROA to analyze the performance of the assets of a company. Here we take the money generated by the income-producing assets and divide it by equity for ROE, or total assets for ROA. Ratio analysis is a powerful tool for investing in the stock market. If you like the idea of being a big player in the stock market and making good investments, check out the book The Intelligent Investor by Benjamin Graham. It's a classic. It is the Bible of value investing, and it's the way Warren Buffett and other successful investors do it. Well, that'll do it for this segment of MBA ASAP. I'm going to make this a 3-episode podcast series on corporate finance. This first one, we went over retrospective information, looking backwards, analyzing financial statements, parsing them apart using ratio analysis. And one key thing to take away from that is that past performance isn't necessarily a good predictor of future performance. Now what we're going to do in the next 2 segments is we'll look forward into looking at forecasting into the future. The first part of that forecasting will be the next segment, and that's going to be the time value of money and present value and future value calculations. And after that, the third segment will be using those present value calculations to investigate the gold standard tools of financial analysis, which are net present value and internal rate of return. So stay tuned. Take care. I hope you liked this episode. Please email me and give me your comments and questions, anything that wasn't clear so I could clarify it. And my email is john.cousins@mba-asap.com. Take care. Have a great rest of your day. Peace. MBA ASAP. MBA ASAP.